Today, we're digging into a pretty explosive claim from our source material that some of the biggest players on Wall Street are quietly making a massive trillion-dollar bet that millions of Americans are about to lose their homes. So, let's get right into it.
So let's talk about the number at the heart of all this, $2.1 trillion. And according to the source, that's not some kind of metaphor. No, it's the actual cold hard cash value of financial bets that have been placed on American homeowners defaulting on their mortgages. I mean, it's a wager on a scale that's just hard to even wrap your head around.
And here's the crucial part, the real kicker. Wall Street doesn't view this as a risky gamble. The argument is that these firms believe they are betting on a near mathematical certainty. Why? Because they've seen a very specific historical pattern play out time and time again.
To really understand this, we're going to walk through the whole argument, step by step. First, we'll look at who exactly is making this bet. Then, we'll unpack the four-stage pattern they're supposedly following. We'll check out some historical examples, apply it to what's happening today, and then, most importantly, we'll cover the source's playbook for how you might be able to protect yourself. All right, so first up, who exactly is placing these bets, and what are they really betting on? Let's get into the specifics. The source names some of the absolute biggest financial institutions on the planet. What they're doing is holding these massive short positions. Now, what that means in simple terms is that they are betting against residential mortgage-backed securities. The very financial products that are backed by your mortgage payments. They make a profit if those securities go down in value, which is exactly what happens when people start defaulting on their loans.
So you have to ask, what gives them the confidence to make a $2.1 trillion bet? Well, the foundation of this entire thing, according to the source, is this predictable four-stage pattern that has apparently shown up before every single major housing collapse in modern history.
So here they are, the four stages. It all kicks off with easy credit, which makes it easy for people to buy homes. That fuels a speculative mania, where housing becomes less about shelter and more about getting rich quick. But then you hit stage 3, the breaking point. Prices get so high that nobody can afford them, and things start to slide. And that's what triggers the final stage, a foreclosure cascade, which is this nasty feedback loop where defaults cause prices to fall, which causes even more defaults. The source says this isn't just a theory, it's a blueprint. So, has this pattern actually played out before? Let's take a look at the historical evidence, which goes back way further than you might think.
Just look at these three examples. We're talking about completely different centuries and continents. You've got the Dutch tulip mania in the 1600s, the British railway mania in the 1800s, and Japan's massive asset bubble in the 1990s. And in every single case, a period of wild speculation, fueled by easy money, led to a property bubble that completely imploded, wiping out somewhere between 60 and 70% of property values. The pattern held.
Okay, so that's a pretty interesting history lesson. But why does it matter right now? Well, this is where the argument gets really serious. The source claims this exact same four-stage pattern isn't just history, it's playing out in the U.S. market, right now as we speak.
Here's how that pattern gets mapped onto the last 15 years in America. Stage 1, the credit expansion, that was the post-2008 era of record low interest rates. Stage 2, the speculative mania, think about 2017 and 2022, with all the house flipping shows and big investors buying up homes. The source argues we hit stage 3, the breaking point, when the Fed started hiking rates back in 2022. And stage 4, well, the claim is, it's just getting started.
And if you want to see what that breaking point looks like in real dollars and cents terms, just look at this. Back in 2021, a $400,000 house with a 3% mortgage cost you about $1,700 a month. Pretty manageable for a lot of people. Today, that exact same house at an 8% rate costs $3,000 a month. The payment has almost doubled. Affordability just fell off a cliff.
And this number, this is the supposed trigger for stage 4. According to the source, there are 4.7 million adjustable rate mortgages, or ARMs, out there. These are home loans that started with a really low attractive teaser rate, but they are all scheduled to reset to the new much higher market rates over the next couple of years.
And right here, we can see the alleged effect already showing up in the data. The source is pointing to figures showing that foreclosure filings are already up 42% compared to last year. This is being presented as the very beginning of that foreclosure cascade, triggered by those homeowners whose payments have already jumped.
Okay, so given this pretty grim forecast from the source, the obvious question is, what on earth can you do about it? So now the analysis shifts from just diagnosing the problem to laying out an actual actionable playbook.
This final section lays out a series of really urgent steps that the source suggests for homeowners, renters, and even investors, all based on this analysis.
All right. For homeowners, the advice is very direct. First things first, know your mortgage. Is it an adjustable rate? If it is, you need to calculate what your new payment will be at today's rates, and you need to do it now. If you look at that new number and know you can't afford it, the source urges you to refinance into a fixed rate immediately, even if today's rates seem high. And finally, they recommend you really understand the foreclosure laws where you live and start building up as much emergency cash as you possibly can.
And the advice for everyone else is just as straightforward. For renters, the message is simple. Do not buy a house right now. Wait for the predicted price drops. And for investors who own rental properties, the advice is to sell now, even if it means taking a small loss to avoid a potentially much bigger one down the road. So, to wrap up the action plan, the source says everyone should be watching 3 key things like a hawk: the monthly rate of foreclosure filings, the total number of houses for sale in your area, and the percentage of those houses that are having their prices cut. When you see all 3 of those spiking at the same time, that's the signal that stage 4 is in full swing.
And this brings us to the final thought from the source. The argument is that Wall Street has already placed its bet. The money is on the table. They believe an unbreakable historical pattern is reaching its conclusion. So the final question is left for you to think about. What's yours?